If you're waiting for the silver or gold bottom, you must see this. Because right now, in boardrooms and central banks around the world, a decision is being made. One that has nothing to do with charts, nothing to do with headlines, and everything to do with what happens to your money in the next 90 days. There is a number buried inside a government balance sheet that almost no one is watching. But it is the single most important number in the global economy right now. And when it moves, it will not warn you first. It will simply happen. By the time most people notice, the opportunity will already be gone. So stay with this video until the very end, because what you are about to see will change how you think about gold, about silver, and about the next decade of your financial life. Welcome back to Precious Metals. Intelligence, the channel built for professionals, business owners, and serious decision makers who refuse to be caught off guard by what happens next in the global economy. Before this analysis begins, a small but meaningful request. If this channel has provided you with clarity, insight, or an edge in how you view the markets, consider joining the community by subscribing. This is not for vanity metrics. It is because this channel is built for a specific kind of viewer, someone who thinks in decades, not headlines, and who values substance over noise. If that describes you, you belong here. And one more thing, the audience for this channel spans the entire world. So wherever you are watching from today, please share your city or country in the comments below. It helps build a picture of just how global this community of strategic thinkers has become. There's a moment that every investor knows, a moment of doubt, a moment where the mind whispers, wait a little longer, watch a little more, make sure before you act. This feeling seems wise. It feels careful. It feels like the responsible thing to do. But history tells a different story. History shows that this feeling, as reasonable as it seems, has cost investors more money than almost any other mistake in the world of gold and silver. This is what analysts call confirmation paralysis. It is the habit of waiting for proof before making a decision, when the truth is, proof never comes in time. By the time the proof arrives, the opportunity has already passed. Smart, careful, successful people fall into this trap again and again. Not because they are foolish, but because their instincts are built for everyday life, not for markets. In everyday life, waiting for certainty is smart. In markets, especially in gold and silver, waiting for certainty is often the most expensive decision a person can make. Here is the uncomfortable truth. A major bottom in gold or silver is never announced. There is no bell that rings. There is no headline that says, "This is the lowest point. Buy now." Instead, the bottom forms quietly, often while fear is still high, while news is still negative, and while most people are still convinced that prices will fall further. Only later, sometimes months later, do analysts look back and say, that was the moment. By then, the price has already moved. The opportunity that once existed is gone, and the very people who wanted proof are the ones now paying a much higher price to catch up. This pattern repeats throughout history. Again and again, those who demanded certainty before acting ended up buying much higher than those who studied the signals and moved with calculated confidence. This is not about luck. It is not about guessing. It is about understanding a simple truth. The market rewards preparation, not perfection. It rewards those who study probability, not those who wait for certainty that will never arrive. This is the real difference between two types of people. On one side, there are those who wait for proof, who need every signal to line up perfectly before they feel safe enough to act. On the other side, there are those who study the available evidence, who accept that certainty is impossible, and who make calculated decisions based on probability and preparation. History has shown, again and again, which of these two approaches leads to long-term success. This is not a story about speculation. It is not about gambling on a hunch. It is about recognizing patterns that have repeated for generations and understanding what those patterns are quietly suggesting right now. For business professionals and serious decision makers, this distinction matters. In business, the most successful leaders are not the ones who wait for every risk to disappear before they act. They are the ones who study the data, weigh the probabilities, and make informed decisions while others hesitate. The same discipline that builds successful businesses is the discipline required to navigate moments like this one in the gold and silver markets. Right now, something important is happening beneath the surface. It is not visible in daily headlines. It is not something casual observers are watching. It is happening in the world of interest rates, government debt, and central bank policy. These forces move slowly, quietly, and without warning. But they carry enormous weight. They are the forces that, throughout history, have shaped the value of currencies and the value of hard assets like gold and silver. To understand what may come next, it is necessary to look beyond the daily price chart. It is necessary to look at the larger economic structure that sits underneath it. This structure involves debt that continues to grow, interest payments that continue to rise, and a fiscal reality that cannot continue forever without consequences. These are not small details. They are the foundation on which the next chapter of this story will be built. What follows is not a prediction based on emotion. It is an analysis based on patterns, history, and structural forces that have played out before. For those willing to look past the noise and study what lies beneath, the picture becomes much clearer. And for those still waiting for certainty, the lesson from history remains the same. By the time the proof arrives, the moment will already be gone. Picture a household that spends more than it earns, year after year, decade after decade. At first, this household borrows a little to cover the gap, then a little more, then more still. Eventually, the interest on what it owes becomes so large that it consumes a growing share of everything the household brings in. This is not a story about an ordinary family. This is the story of a government. And right now, this story is playing out on a scale the modern world has never fully faced. The numbers behind this story are difficult to ignore. Every year, the cost of simply paying interest on existing debt continues to climb. This is not the cost of new spending on schools, roads, or programs. This is the cost of paying interest on money that was already borrowed in the past. That cost is now consuming a larger and larger share of total government revenue. When a government spends more and more of its income just to service old debt, it has fewer resources left for everything else, and it becomes trapped in a difficult position with very few good options remaining. This matters more than most people realize. When a government finds itself in this position, history shows there are only a limited number of paths forward. It can raise taxes significantly, which is politically painful and often economically damaging. It can cut spending sharply, which is equally unpopular and difficult to execute. Or it can find a way to manage the situation quietly, using tools that do not require public votes or difficult political battles. This third path has a name in economic history. It is called financial repression. Financial repression is not a new idea. It has happened before in the middle of the last century when governments faced a similar mountain of debt after a period of enormous spending. At that time, policymakers found a way to keep interest rates artificially low, even while prices for everyday goods were rising. This allowed governments to pay back their debt using money that was worth less over time. It was, in effect, a quiet transfer of value away from savers and toward the government. Those who held cash or fixed investments during this period lost purchasing power. Those who held hard assets, assets that could not be printed or diluted, preserved and grew their wealth. This is the pattern that serious economic historians study closely today, because the conditions now closely resemble the conditions of that earlier period. Debt levels are historically high, interest costs are rising rapidly, and the tools available to address this problem are limited. When faced with these same pressures in the past, governments consistently chose the path of least political resistance. They chose to manage the problem through currency and interest rates, rather than through difficult budget decisions. This path, while politically convenient, tends to reduce the value of paper currency over time. This is precisely where gold and silver enter the story, not as speculative trades, but as historical stores of value during periods of currency stress. Throughout history, when governments have faced unsustainable debt and turned to these quiet monetary tools, hard assets have served as a form of protection. They cannot be created out of thin air. They cannot be printed to solve a budget problem. Their value is not tied to any single government's promise to pay. This is why, throughout centuries of financial history, gold and silver have played a consistent role during periods when trust in paper currency begins to erode. It is important to understand that this is not a short-term trading opportunity. This is not about a single news event or single interest rate decision. This is a structural story, one that unfolds over years, sometimes over a decade or more. The forces driving this story, rising debt, rising interest costs, and the difficult choices governments face as a result, do not resolve quickly. They build slowly beneath the surface, largely unnoticed by the general public until the consequences become impossible to ignore. For business professionals and strategic thinkers, this is the kind of information that matters most. It is not about reacting to headlines. It is about understanding the deeper structural forces shaping the economic environment and positioning accordingly well before the broader public begins to notice. Those who understand this dynamic early are not gambling. They are preparing. And as the next part of this analysis will show, the signals confirming this shift are already visible to those who know where to look. Every market tells two stories at the same time. The first story is the one everyone sees, the daily price, the headlines, the short-term swings that dominate conversation. The second story is quieter. It moves beneath the surface, hidden inside data that most people never think to look at. The second story does not care about yesterday's headline or today's mood. It reflects something deeper, what large institutions, professional fund managers, and serious researchers actually believe based on how they position their money. This is where sentiment analysis becomes powerful. Large financial institutions regularly survey professional fund managers, asking them directly how they feel about certain assets. Do they see gold as overvalued or undervalued? Are they holding more of it or less? These answers are not guesses. They represent real positioning, real capital, and real decisions made by people whose job is to manage enormous sums of money. And when this data reaches extreme levels, it often reveals something important, something that the average observer completely misses. History shows a consistent pattern. When professional sentiment toward gold and silver becomes extremely negative, when most fund managers believe prices will keep falling, this is often not a sign of continued weakness. It is frequently a sign that the selling pressure has already exhausted itself. This may sound counterintuitive. It may even feel backwards. But this is exactly how contrarian analysis works. When almost everyone has already sold, there are very few sellers left. And when selling pressure fades, prices often stop falling, even before positive news arrives to explain why. This same pattern appears across multiple independent sources. Specialized research firms track daily sentiment data using their own indicators, smoothing this information over time to identify extreme readings. When this data reaches levels only seen a handful of times in recent decades, it draws serious attention. Historically, these extreme low points have appeared shortly before major turning points, sometimes weeks before, sometimes a few months before. This does not mean the exact bottom is easy to predict. It means the broader window of opportunity is opening, and disciplined investors are watching closely. Separately, other respected research organizations construct their own sentiment measurements, combining multiple indicators into a single score. These organizations have built their reputation over decades by studying market psychology, not by chasing headlines. When their data also reaches historically low levels, it adds another layer of confirmation to the picture. No single data point tells the whole story on its own, but when multiple independent sources, built using different methods and different data sets, all point toward the same conclusion, the signal becomes far more difficult to dismiss. This is the discipline that separates professional, strategic thinking from emotional reaction. It is easy to look at falling prices and feel fear. It is easy to look at negative headlines and assume the worst is still ahead. But seasoned analysts learn to do something different. They learn to treat extreme fear as information, not as a warning to avoid an asset, but often as a signal that the asset has become deeply undervalued relative to its true long-term worth. This approach requires patience and discipline. It requires the ability to separate short-term noise from long-term signal. Daily price movements are noise. They are driven by short-term trading, temporary news, and emotional reactions. Sentiment extremes, on the other hand, reflect something more structural. They reflect the accumulated psychology of an entire market, built up over weeks and months, not minutes and hours. Understanding the difference between these two types of information is one of the most valuable skills a serious investor can develop. For business professionals who already understand the value of data-driven decision-making in their own careers, this concept should feel familiar. Successful business leaders do not make major decisions based on a single day's results. They study trends, they study patterns, they look for confirmation across multiple sources before committing to a direction. This same principle applies directly to how gold and silver should be analyzed. The signals are rarely perfect, and they never arrive with complete certainty. But when multiple independent measurements align, pointing toward the same conclusion, disciplined investors have learned that this is precisely the moment worth paying close attention to. As the next part of this analysis will show, understanding these signals is only the beginning. The real question becomes what one chooses to do with this knowledge, and what waiting too long could ultimately cost. There is a simple truth in business that every experienced professional eventually learns. Waiting for perfect certainty is not caution. It is often a hidden cost, one that rarely shows up right away, but always shows up eventually. This truth applies just as strongly to gold and silver as it does to any major business decision. The investors who insist on complete certainty before acting are not protecting themselves. In most cases, history shows they are simply paying a higher price later for the exact same decision they could have made earlier. This is what economists call asymmetry of risk. It means the cost of waiting and being wrong is often far greater than the cost of acting early and being slightly early. When someone waits for undeniable proof that a bottom is formed, they are not eliminating risk. They are only shifting it. They trade the risk of being early for the much larger risk of paying significantly more once the recovery is already underway and confirmed to everyone. By the time the proof they were waiting for finally appears, a large portion of the opportunity has usually already passed. History offers many examples of this pattern repeating. In past cycles, those who waited for absolute confirmation before entering the market often ended up buying at prices far higher than those who acted earlier, based on careful analysis rather than certainty. This was not because the cautious investors lacked intelligence. It was because they misunderstood how markets actually work. Markets do not wait for confirmation. They move first, and confirmation follows only afterward, often after most of the gain has already occurred. This is why disciplined investors focus on probability rather than certainty. They They do not need to be completely sure. They need to be reasonably confident, based on the evidence available and willing to act, while conditions remain favorable. This mindset mirrors exactly how successful business leaders operate in their own industries. They rarely wait for perfect information before making a decision. They gather what data is available, they weigh the risks carefully, and they move forward with calculated confidence, understanding that no decision will ever be completely free of uncertainty. It is important to be clear about what this means and what it does not mean. This is not a call for reckless action or blind speculation. It is not a suggestion to abandon careful analysis. It is the opposite. It is a call for strategic preparation, built on historical patterns, structural economic pressures, and sentiment data that has proven reliable across many previous cycles. The goal is not to guess the exact bottom. No one can do that with certainty, not even the most experienced analysts. The goal is to recognize when the broader conditions strongly favor patient, long-term positioning, even while some uncertainty remains. This distinction matters enormously for business professionals and serious decision makers. In business, the most successful outcomes rarely come from those who wait until every risk has disappeared. They come from those who study the available evidence, accept that some uncertainty will always remain, and make informed decisions while others are still frozen by hesitation. The same discipline applies here. Those who wait for a guarantee are not being careful. They are simply choosing to let others act first and accepting whatever higher price remains once the outcome becomes obvious to everyone. The lesson from history is consistent and clear. Those who study patterns, respect structural economic forces, and act with calculated confidence tend to benefit far more than those who require absolute certainty before making any move. The cost of waiting is rarely visible in the moment. It only becomes visible later when the price has already moved and the opportunity has already narrowed. What remains now is to bring these pieces together and to understand what this moment truly means for the years ahead, and why the final conclusion of this story matters more than any single chart or headline could ever show.